Hello, financial students. Welcome to Chakani Institution. Hashtag our pride is more educational. So today I want us to go through chapter 21, which is the cash flow statement. So as you know that the cash flow statement, it's about determining the inflow of money and the outflow of money. So today, as you know that the cash flow statement have four parts or four activity. We have a cash flow from operating activities. We have a cash flow from financing activities. We have a cash flow from investing activities, and also the net change in cash and cash equivalent. So today we are going to focus on the first activity, which is the cash flow from operating activities. So what is important on the cash flow, students, is that you need to know the format. So on this activity that we want to do today, the format or what must be included on this activity. Number one is a cash receipts from customers, cash paid to suppliers and employees, cash generated from operations, dividends received, interest paid. Remember, the interest paid is the same as the finance cost, and also the dividend paid. And then that's where we'll get the net cash inflow from operating activities. So let's focus on the first thing, which is the cash receipts from customers. How do we calculate the cash receipts from the customers? If you can check on my calculations there, sorry, I have indicated number one, we are calculating the receipts from customers. How do we calculate these receipts or a cash from customers? We need to construct a T account called the reconstruction of the trade receivables. This account is an asset, increase on the debit and decrease on the credit. So now, the format of this account is that you need to have a balance brought down on the debit, you need to add the sales. And then on the credit, the bank is the one that you are looking for. That is the cash receipts from the customers. And then you need to consider the allowance for doubtful debts. If they are not, they are subtracted. So you need to make sure that you add them back. You need to consider also the bad debts written off if they are not yet considered. And then you're going to have a balance carried down on the credit, which is from the balance brought down here. I made a mistake, supposed to be balance brought down. And then the balance brought down will go back to the balance carried down. So when you go to the activity, the example 21,4, we have the balance at the beginning. Let's go to the activity. The balance at the beginning, you can see on the trial balance there, the trade receivable after allowance for doubtful debts. We have balance at the beginning 16,020,000. That is the balance at the beginning. Balance at the end is 17,100,000, and then we took those balances to the T account. We put balance brought down of 16,020,000, and then we put the balance brought down there as 17,100, and then we take it back to be balance carried down as 17,100,000. And then we need to check where is our sales. When it comes to the issue of the sales now, make sure that you consider whether there's adjustment or not. So when we check in our activity, the sales is affected by the first adjustment. They said the information below was extracted from the statement of profit or loss, where we have the sales, the profit before tax, income tax, profit for the year. So we are looking for sales, which is here is 60,500,000. Then we copy that amount we recorded on the debit side of the reconstruction of the trade receivables. After that, we consider that the credit side, you are looking for the bank, the one that is a cash receipts from customers. So all the time when you do these calculations, consider the allowance for doubtful debts. The allowance for doubtful debts and the bad debts written off must be considered, unless if they've already considered for you. So here we were affected by the adjustment number 11. According to the adjustment number 11, they said trade receivables are presented after the allowance for doubtful debts had been taken into account, meaning that you are given the trade receivable after the allowance have been subtracted, and we need the one where the allowance was still included. And then they said the allowance for doubtful debts was increased by 130,000. So 1,000 was already removed from the information. And then we have a bad debts to the amount of 420,000 were written off during the current reporting period, meaning that these things happen at the end, meaning that the balance at the end is affected by this allowance for doubtful debts and also by the written off. So the bad debts have not been minus from the trade receivable. So that's why you can see I have recorded them on the credit side. Even the allowance for doubtful debts, you know that they decreased the trade receivables. They have recorded on the what? On the credit side. And then on the debit side, always you only have a balance brought down and the sales. The rest, allowance for doubtful debts, the bad debts written off, they affected the credit side of this account. And then we totalize. Always we are looking for the credit side. And then we add 16 million, which the balance brought down 16 million and 20 plus 60 million 500. Then we get the total of 76 million 520,000, which is leading the both side. You know how to balance the T account, I'm sure. And then after that, we check when we add allowance for doubtful debts of 130,000 plus the bad debts written off of 420, sorry. And then we add together with the balance carried down of 17 million 100. They were not giving us 76 520. Then we minus to see how much is the balancing that is needed for the credit to be equal to the debit. And then when we minus all those three amounts from that total, it gives us 58,870,000. And then we copy it to the first activity. It's 870. It's a million, and then it's recorded. And then once you record on that activity, you need to ask yourself whether it's an inflow or outflow. So the cash receipts from, once it's from, meaning that we are receiving as a company. So I'm sure it was useful. You have understand how to find the cash receipts from customers, which we have to construct the account called the reconstruction of the trade receivables. So see you on the second episode when we deal with the cash generated from operations. See you next time. Thank you.